Welcome back to my channel, Balance Sheets Matter. In this video, we're going to be looking at Tractor Supply Company, TSCO stock, and do a stock analysis where I'll be explaining largely the reason why they've fallen so much. Less than a year ago, Tractor Supply was trading around $60, and now it's down over 50%, down to just over 30. So we're going to be diving into the financials, seeing why basically this has happened, if it might be a good buy right now, or when we would want to be looking at it potentially to be a good buy in the future. But before we get into the stock analysis, make sure to subscribe to my channel. Balance Sheets Matter. I do individual stock analysis videos. So if you like looking at individual stocks, want to get good ideas on potential stocks to buy, value traps to avoid, make sure to subscribe to the channel. And if you do want me to look at a stock, leave it in the comments below, as I do frequently get to subscriber requests. And of course, like the video, because that, will help it out. So let's look at Tractor Supply now. So looking at a few of the top level metrics here, sometimes the guru focus value band can be accurate in saying we are potentially sitting on the significantly undervalued side. So we're going to basically dive a little bit deeper and see if that's correct. And right now we can see Tractor Supply sitting at a 14.84 PE ratio, and it has a forward PE of only 14.19. Meaning the estimated EPS growth going forward in the next year is expected to be pretty minimal, pretty much actually in line with what they're currently doing. And on top of that, they have a dividend yield of 3.12%, which is a reasonable dividend with a payout ratio of 0.46. And they do a few share buybacks basically, but only averaging about 1.5% per year. So as many know, they did have earnings at basically, I think it was April, released them on April 21st, and there was quite drop. And I will just kind of highlight one thing before we get into the financials. They did reaffirm their basically outlook for the fiscal year. So, well, the analysts basically have, as you can see, have on pretty much all of them, revised their price targets down, and some of them actually lowered from overweight to neutral or kept it on a hold. Well, there's some remaining buys. If you look at the price targets here, they've all revised them down. And while these price targets, some may look attractive at $40, $50 compared to the current price, well, we have to look a little bit deeper to see if that's actually going to be the case. So let's dive into the financials here. And the first thing to kind of note is the revenue trend line here. And we can see basically the average growth rate per share for revenue has been 13.8% per year. And this is basically reflected by the average of this blue line right here. And if we're projected to go into the future, it will continue up at this trend. But based on currently the company's own guidance and the analyst estimates, it is expecting to moderate more going forward in the future at this green trend. So that is one key important thing to understand about Tractor Supply, is that they're likely not to be growing at the same rate that basically they have in the last 10 years in the next 10 years going forward. And you can even see just on the chart here, as we'll reaffirm the financials, the last few years, their revenue basically has been flat for the last few years. And even in their earnings here, in their estimates, they're basically net sales, their outlook is only looked to be 4 to 6%, which even if we apply in some share buybacks there, is pretty much half the rate they were previously doing. And basically in the last 10 years also, they did have EPS growth of about 15.7% per share as well. So diving down into financials, one first thing to basically check to see what's happening is the return on invested capital. And just kind of ignore this point from 2018 to 2019, because they basically had to start recording their net lease obligations in their balance sheet there, which increases their assets and therefore lowers the return on invested capital. But the one key thing to keep in mind here is you can see from 2019, well, it did actually maintain up to about 2023. The return on invested capital has dropped quite significantly in the last few years, down to 13.48% in the last 12 months here, which is not a very basically good sign overall, because that means they're investing money into the company to open new stores, but they're not getting as good returns basically as they were in the past. And we can see while the revenue trend has been going up overall, the last few years has been positive. They have started to re-accelerate that pause by getting a little bit of revenue growth, so that 4 to 6% going forward probably is pretty reasonable. And one good thing to see actually is with this, they have maintained a high gross margin still. Actually, the gross margin has increased a little bit, which is a very good sign overall, but also might have been the reason why they weren't getting that revenue increase from 2022 to 2024, because they were deciding to keep their gross margins higher. And when you kind of keep your prices a little bit higher, especially everybody knows there's a lot of inflation happening in 2022, and who knows, there may be some more basically continuing on happening in the future. But when you kind of keep your prices higher to maintain those gross margins for tariffs and other basically costs going up, that does sometimes lead to lower sales overall. So that might have been the reason for basically the pause in sales there. But then we get down into the operating income, and this is where there's a little bit of weakness that basically starts to show, as you can see that the operating margin has basically been starting to drop a little bit. Where in the past years, most of these past years, it was more maintaining around 10%, sometimes some brief dips down to, under 9%. It has started slipping down again. And in the last quarter here, actually, it was down to 6.5%. And we're just going to compare this to get on a quarterly basis here, which I can find where the quarterly is, all quarterly. We'll go down and see how that's compared to, previous same quarter. So, 6.5% for here for March, which if you look, the March 2025, 7.19, 7.75, 7.14, 8.08. In the last several years, this is basically the weakest March quarter. So sometimes when you do have a little bit of changes in the net margins from quarter to quarter, to really see if we are getting a really off quarter here, you kind of do have to look on the quarterly basis and see what's happening. And you can see this compared to at least the last several years is a weaker quarter than has basically is, which is a bad sign. And that may mean there's a little bit more margin pressure going on in the future, because the one problem happens, especially with retail stores, is because of inflation, well, you're selling in general admin because you need the same amount of employees, everything will keep on rising. And even though basically your revenue isn't rising, the selling in general admin can basically outpace that, which has been happening in Tractor Supply's case here. One good sign, though, is their interest expense is very low at only $69 million. And this is really, really low compared to their operating income of just over 1.4 billion. So this is a really good basically leverage ratio they have. I usually like to look for at least 10 times more operating income than interest to consider it like a healthy interest expense. And they have plenty more than that. So they're sitting very good in that regard, at least. And then we come down basically to the bottom line, and you can see the net margin basically is down to 6.91%. And well, it was lower here. The tax rates were also higher. The tax rates basically have got lower, basically in 2018 because of some new laws and everything. And, kind of now they're over the last few years, you can see from 2021, it was 7.83, and it's basically reduced down to 6.91. So this is kind of getting into a little bit of the trend, which we were kind of starting to see appear on these top line metrics here of the revenues and the operating margins, is that basically their margins are slowly starting to be squeezed. And this is one thing that basically the analysts, do take very seriously as, and can fetch lower PE ratios going forward in the future. And even though, well, they are buying back basically a few shares, this, as we already looked, it was a relatively low return to shareholder of only 1.5% per year over the last few years. And effectively since 2020, you could actually almost say since 2022, the EPS basically has almost been flat. But as we saw, the revenue hasn't been rising either. So this is one thing that, well, Tractor Supply over the last few years actually was maintaining a kind of high price. Since they really haven't reaccelerated again, now maybe the market is kind of realizing that they're not going to resume their previous trend they were in the past, and we kind of need to start looking at fair repricing for this company, which is not everything's bad. We can see that there are some, highlights for them, especially in their interest expense there, and at least maintaining their gross margins. So getting basically down onto their balance sheet here, the current ratio is looking really good. $4 billion in assets over current assets over $2.9 billion in current liabilities. We look at the total assets sitting a little bit over $11 billion, and the amount of intangibles and goodwill is very, very low. I think this line here is just not showing up, but it's actually probably this $347 million. So most of their assets are real, but it's going to be in plant, property, and equipment because, well, they're a physical retail store location effectively. And then we look down at the total liabilities, just over $9 billion there, which does kind of leave a real tangible equity sitting about $2.5 billion. And we can see their overall debt, where it has been basically creeping up over the years, is sitting a little bit over $2 billion. But they are only paying $69 million in interest expense for this. So if they really wanted to in the future, they actually could do like an acquisition, for example, to help fuel the growth there. And they can do this with debt and actually take on quite a bit of more debt quite comfortably without causing too many more issues. So this does leave them a lot of maneuverability basically going on in the future. When we get to the cash flow statement, one important thing to look at is basically the cash flow from depreciation and compare it to what the purchase of plant, property, and equipment is. And we kind of have to remember that before the last 10 years, they were growing at a lot faster rate. And you can basically, it was around that 13%, at least on a per share basis. Or, it's 12 point something even without the per share basis trend. And that's going to be changing now. And you can see basically you would be expected to purchase more plant, property, and equipment, which frequently was about 50% on average, sometimes up to 100% higher than the cash flow from depreciation, which is a pretty normal type of thing that's basically happening for a faster growing company. But what's basically started happening in the recent years is they've actually suddenly upped their purchase of plant, property, and equipment quite a bit more. And the ratio kind of compared to the past is relatively the same or even higher, but we are expected to have lower growth basically going forward. So that's kind of one thing you need to keep in mind, is that when these numbers of the purchase of plant, property, and equipment basically are significantly higher than the cash flow from depreciation, it kind of means your net income at the end of the day really isn't potentially as high as we're seeing on the income statement, at least from more of a average cash flow perspective. And while it is maintaining like this higher spend, basically that it was basically at the pass from the ratio compared to their current depreciation, they aren't growing as fast anymore. And that's basically one of the reasons why their return on invested capital is dropping. So this is one thing to kind of keep in mind that I would say basically is a negative for the company's growth trends, that they have to keep investing this money into the company, but they're not really getting the growth and returns from it like they were basically in the past. And you can see they've done a few small little acquisitions here, and we'll see if more of those happen in the future. I kind of feel that since they've, really are moderating more in the growth trend, they are going to be potentially looking at doing an acquisition in the future. As I said, their balance sheet is quite healthy, and they could basically support that. Now we can also see there's a little bit of stock-based compensation, so you do have to buy back a few shares to offset this, but we're only averaging about $60 million per year in that. And repurchasing the stock, it does, vary up and down, but last year basically it was about 400 million. And, they have had years that were a little bit higher, but I'd probably not expect them to, actually do that much more, because if we, look at basically their cash flow from dividends, the cash flow from dividends is almost $500 million. When we look at their free cash flow, sometimes you just got to remember that things like changes in payable or inventory or working capital can affect your free cash flow. But if you look at the last few years being around that, maybe that 5 to 700 million range, once you're taking out your $500 million for dividends, you really actually don't have a lot of workability to buy back a lot of stock going on in the future. And well, they do have basically a good balance sheet, and with their current assets, you can see actually the cash is like relatively low, so they actually have to sell through some of their inventories to get the cash to be able to buy back stock, because their current ratio is healthy. If they did want to basically maintain the level of buybacks they're currently doing, they would either have to basically be taking on debt, which would not really be ideal for doing buybacks, or they're going to have to probably take it off the balance sheet basically, which is going to reduce that total equity, but they would actually need the cash flow to come in from that, or they're going to basically have to potentially scale back the buybacks a little bit. So that's just something to basically kind of keep in mind there for it. So let's kind of get into the interactive chart here, do a little bit of a relative analysis. I'll bring up the revenue with estimate again, and you can see basically the trend that's expected to be going, where it's been kind of a little bit pokey and flat for the last few years, and they are expecting it to kind of reaccelerate a little bit back into this 4 to basically 6%, which they basically reaffirmed in their guidance here. And when we bring up the EPS with estimate, this starts telling a little bit of the story, since you can see that the EPS basically has been flat, and even for the current year 2026, this is pretty much in line. Right now the average analyst estimate is $2.13, and that's pretty much in line with what the company is currently guiding. But then you can see after that they are basically expecting the EPS to reaccelerate again. And the important thing to keep in mind about this is the EPS is basically expected to accelerate above the previous revenue trend there, which basically is implying they are, after at least 2026, expecting those margins to recover. So based on the analyst estimates right now, this is still really only pricing in that the margins are going to stay suppressed basically for 2026, and then things are going to kind of keep on trucking, on that, previous, trend they basically were before, with operating margins going up. Because I'll bring up basically the margins now, the operating margin, and let's just get rid of we can keep the revenue trend line there. And you can see basically after 2008, they were basically able to raise them quite significantly. And they did reach a high of operating margin here about in 2016 of 10 here. And then they basically came down to about this, 8-9% range. And right now it's, got back up, but this was a lower high. So I think that's something is to keep in mind of potential slow margin trends that are happening, since these things can happen very slowly. And I've gone over in a lot of videos how it might take like 10, 15 years to really see that trend in margin deterioration happen. But now there's basically been a lower high in the operating margins, and they're starting to basically trend down again. And we saw, the last quarter in March was down to 6-something%, which could mean that it could get down to these levels or even potentially a little bit lower. So that's something just to kind of keep in mind of at least short-term developing weakness, that basically could be happening in tractor supply here based on the current trends that are occurring. And if we pop up the P ratio, let's just wait for that to load up. We'll take away this revenue with estimate here. Sitting at 14.82, and historically this is a relatively good ratio. It did get pretty close down to in 2020 at 16.7. It actually did reach down, I believe, probably 15 or like around 15 in 2017. In 2008, it was actually down to a 12 multiple times, and down in 2000, which, it actually got down even lower down to 3, which maybe just be like a one-off thing, but even from this point here, it was a 9. So there's definitely been times it has been lower, and, kind of 2008 going forward has been, up until now at least, an overall positive net up cycle. So, well, 14.82 is relatively attractive. I do think we have to keep in mind that if they do show a little bit more weakness, you could get a little bit more downside in that. And then we'll bring up the price to sales ratio, which is another way to basically look at this. And you can see it's down to 1, which is about relatively compared to these 2017 lows here. And that kind of went in the same trend of where the operating margins were. But if the operating margin trend, because remember we had a high around here, and then it basically broke down to about 9%. But right now it is looking in the short term, the operating margins could potentially break a little bit lower. So it may not be lower as these trends here, since as we previously saw, the operating margins were significantly lower, but it wouldn't be too infeasible to basically see the price to sales ratio come down kind of between these two levels if there is any more weakening on those operating margins. So going into just a few more little analysis basically on, what actually could be a good price here, is I've basically started doing this is a nice little way to basically kind of visualize this. This is just like a little kind of discounted, cash flow calculator for 5 years. So I'm taking the analyst estimates of $3.15, and we have to remember that that's kind of based on their EPS basically reaccelerating back up to the previous levels it is. So I think these are already kind of bullish type, lofty type estimates. And if there is, any quarter with, that doesn't basically reaffirm that, oh, there's going to be a reacceleration in the operating margins, then these estimates are all too high, and you would have to basically expect to lower them. And I'm also taking the PEs of, 20 and 25, since if we go historically here and bring them up, those were the kind of more the upper band PEs. Can see most time like 25 there, got maybe up to a 26 there, 27, but really it's never getting over 30. And we also have to remember during this period, here, and especially back here where it actually was getting up to a little bit 30, the growth was a lot faster. So 20 to 20, basically 5 is probably on the higher end of what they would be based on the growth trends going forward. And right now with the current estimates, it's, as an EPS, compound annual growth rate of just under 10%. But you can see how this kind of would change. If you would expect this to be a little bit lower since the operating margins don't reaccelerate as much, you can see how this basically starts affecting the numbers here. And for these relatively high P ratios, these don't become as attractive as returns. And additionally, on top of that, if you say, hey, they probably may fetch a lower PE basically going in the future, you can see basically how much that effectively affects your expected returns basically going forward. Since typically kind of on this type of analysis, when you're taking the higher P ratios, you really need to see something that's more kind of in these ranges, in my opinion, to be kind of triggered as a buy for this type of discounted cash flow calculator, which basically, we're really not seeing right now with a reasonable of 20 to 25 PE. 23 may be good, but this is kind of assuming these more lofty estimates. So when we get to kind of the technical analysis here, my chart, you can see this long-term trend, which I think is kind of, pretty good here. And you can already see basically it's a very, very sudden drop, and it's kind of the first drop that started happening, which usually a lot of the times when you have one drop, there's maybe some bounces, but there's definitely more basically drops to follow. It's not just one and done, and just the pure acceleration of this kind of does hint to me that there probably going to be some more downside coming, since I don't see that it's at a super attractive price right now, even estimating in the more lofty 5-year analyst estimates. And especially considering there's kind of the analysts kind of they're cycling down on all the estimates basically are going down. That's not a good positive trend to be at. So if you are like having in these negative analyst estimate cycles, you definitely do want to be seeing, a higher potential compound annual growth rate going on in the future, but a lot higher than this in my opinion. So that's why I kind of have this level mark down here at, $19, because I think just, kind of on momentum alone and, technicals, and you can see here with the price volume profile, this would be a very technically good spot to basically buy Tractor Supply Company here. And with the very little bit of amount of price action that's happened in between and the momentum and all the other factors, I think it actually would be pretty probable they basically potentially get down here. They might bounce in the meantime. Like I said, nothing happens in, one go, but if they basically show any type of weakness in the operating margin going forward, we can probably expect them to eventually fall down to here. And that's kind of where I think they start getting on a much more attractive price. Since if we were to basically take current price, change it to, 19, which is my target there, you can see how these numbers suddenly get very, very attractive. And even if we were to target lower PEs, they are still a very attractive number. So anyways, that's like really where I would personally be wanting to buy Tractor Supply, is kind of, wait for $20. I could see how some people could potentially see it's attractive now, but just currently the beginning kind of a negative sentiment cycle for them. This is, not looking like my cup of tea right now, and really isn't providing as much, upside as I would want to see with that. So anyways, that is my stock analysis on Tractor Supply Company. Let me know what your thoughts are in the comments. Make sure to subscribe to the channel and like the video, and I will see you in the next stock analysis.